Welcome back to All Things Money. My name is David Blain, and during today's show, we're giving you a good strategic overview of the portfolio construction process, a very important part of designing your investment strategy is this portfolio construction. As I mentioned last segment, CNBC, the Wall Street Journal, the popular media, the majority of the focus on picking that right stock or picking that right, being in gold, not being in gold, at the micro level. What should I do this week? What should I do this year? Well, we want you to step back and sit down and consider the overall strategic process, the portfolio construction process, and to try to get a handle on your risk objective and your return objective. Now, that doesn't mean that at some point you don't have to get down to the micro level and pick stocks, but my point is that if you're trying to decide whether to invest in Ford and GM, but you don't know what your capacity to assume risk is, you don't know what your return requirements are, well, how do you know where does Ford or GM fit into the grand scheme of things? Or should you be buying the stock of GE or the bond of GE? Well, some of these decisions have to be made at the strategic level. And so we want you to step back and take some time and examine your tolerance for risk. There are some good online surveys. We have a very good one. It's designed by a company called Finametrica. They're actually out of Australia, I believe. And it's designed by some psychology professors, kind of along the lines of the Briggs-Meyer personality tests and things of that nature, where it helps assess your willingness to assume risk by asking a series of 25 questions. Now, the real benefit of this survey is not whether it can determine your absolute risk tolerance, but rather a relative risk tolerance. And what I mean by that is this company has built a database of hundreds and hundreds of thousands of people from around the world that have taken this survey. And so when we finish giving this to someone, we can put them on a scale. Let's say that they score a 75. Well, that means that they are in the more risk aggressive than normal. And by normal, we mean of all the other people that have taken the survey. So it doesn't exactly tell you how much risk that person is willing to take. The whole scale may be shifted towards very risky or very conservative, but at least it enables us to put you somewhere in the scale of risk tolerant or risk averse. So we think it's very important that you spend some time thinking about your willingness to assume risk. A good way to do this is look at your portfolio statement today, and let's say it's $100,000, and you ask yourself, well, if my statement shows up tomorrow and it's $95,000, is my stomach gonna start to churn? Well, let's say you have a $10 million portfolio, and your statement arrives, and this month it's now $9 million. Is that going to make you uneasy, or do you think, well, I have plenty of money, that doesn't bother me, I know it will recover? So that's just kind of a shortcut to start to think about your risk tolerances. Think about the amount of money you have in your investments right now, and think about a number that would start to make you feel queasy. I mean, some people, 25, 30%, declines doesn't bother them. Other people, if they ever see the portfolio go down, they just get completely nervous and upset, and that's a hypersensitivity to risk. We also encourage you to take a look at your capacity to assume risk. Typically, some things that we look at for that is, look at the number of dependents you have, look at your job stability that you have. Are you self-employed? Do you have a guaranteed pension? Are you eligible for Social Security? Are you older? Are you younger? All these type of things go into your ability to assume risk. The other side of the equation that we talk about is the return side. Most people have a return desire or expectation. I want to make 20% a year. Well, that's unrealistic. You need to look at the capital markets and to see what types of returns are available. And it's just not 20% a year is just not available on a consistent basis. Sure, you may make that in 1 year or a couple years in a row, but it's just not a realistic expectation in the public capital markets to achieve that type of return. You would have to go into some sort of business for your own to try to achieve those types of rates of return. At the same time, on the people that are too conservative, they're happy getting today nothing on their savings account or nothing on a CD, where the reality is they don't understand for really almost no more risk they could invest in government treasury bonds or something and get an incremental return. But to leave your money in cash and receive nothing, their return expectations in that case are actually too low. Then we talk about the return requirements. Is what are your needs? What are your goals? Do you need to send your kid to college? Do you need to fund a new heart wing at the hospital? Are you trying to save up $20 million, or are you trying to save up to retire? These are your return needs. And once again, if you don't have a good handle on what you're trying to accomplish, the overall portfolio construction process does not make sense. If you're trying to fund a new wing in a hospital and is your lifetime goal, and you have $1 million in your account and you're investing all in CDs, well, your return requirements are much higher than what you're currently investing in. And so you have to make sure that these four parts match together. This is a favorite topic of mine. It's one that is the most difficult part of investing. As I mentioned at the outset, the, quote, easy part of investing is picking the individual investments. It's designing a portfolio that the client will be happy with. Well, that's about all the time we have for today's show. I want to give you a quick sneak peek of next week. We're going to kind of continue on this topic, and we're going to talk a little about designing a portfolio and making sure that it aligns with your investment beliefs. Kind of like your risk tolerance. If you have a portfolio that you designed or you took from somewhere else or an advisor designs for you, and it just doesn't line up with certain core beliefs about investing in the markets, you're not going to be happy with it, and you're not going to be able to achieve your goals with that type of portfolio. So tune in next week, and we'll be talking about investing beliefs and your portfolio. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.